Oh, here we go, Jordan. Good evening. I see people coming into the room, which is always exciting.
So
Welcome, welcome, everybody. We've got a few more minutes until we get started. We've got a really high participation level tonight, Jordan. We're expecting probably about 150 people registered tonight, and so I think we're going to get a good response from people. A lot of people curious about mortgages. So for those of you that are joining us, we're going to just wait a few more minutes. We will be getting started in just a minute, letting people filter in through the waiting room. Oh, lots of clients I recognize on here already. This is great.
exciting.
Okay. Jordan, how are you tonight? Now you're just north of the city, you're in Newmarket. Did you dig out from this monster storm?
Yeah, it was crazy. I'm very lucky to have amazing neighbors. And I don't know if anyone else can say this, but I didn't shovel once through that snowstorm.
Really?
That's
Somebody
how
came along
amazing.
and like snowed out, uncovered
Yeah.
your,
Yeah, all of it. I feel so
oh, good for
grateful.
you. Okay. You're going to
Yeah,
have to do something nice for all of your neighbors.
I know. I know. That's the thing is like when it comes to handiness, I have nothing to offer. Those are really the guys. Cooking I can do, baking, cooking,
And
but
good financial advice. So
they'll always get free mortgage advice. So they
free
can relax.
mortgage advice. Well, let's get started, everyone, because it's just after 7 o'clock and we have so much to unpack. So, good evening, everyone, and welcome, welcome, welcome. As you may know, my name is Carol Foderick. I'm the broker of record here at Signature Elite Realty, and we are here to talk about everything mortgages with Jordan Lee. So, I appreciate you guys taking the time to be here. I know life is busy, and I appreciate you guys choosing to spend part of your evening with us. Tonight's session is part of our Signature Elite Realty Client Masterclass series, where our goal is pretty simple to bring clarity, confidence, and practical guidance to homeowners and buyers who are navigating what seems to be an increasingly complex real estate landscape. These sessions are designed for real people making real decisions. So, whether you're preparing to buy your first home, you're considering a move, maybe you're approaching mortgage renewal, where a record number of people are in the process of doing that this year, or maybe you're just trying to, make sense of what you're hearing in the headlines. We believe our responsibility goes far beyond helping our clients just buy and sell homes. Our role here as your realtors is to educate, to advocate, and to just help our clients make really informed decisions that protect their financial well-being and your long-term financial goals. Real estate is probably one of the most significant investments that most families will ever make, and the financing decisions behind it are just as important as the property itself. Again, for those of you I haven't met, my name is Carol Foderick. I've been in real estate for almost 25 years. I lead one of Canada's top producing teams. And as I said already, I'm the broker owner of Signature Elite Realty, which is an independent brokerage here in the GTA built specifically around high performance teams and exceptional client service. Over the years, I've had the privilege of working with thousands probably of buyers and homeowners. And I can confidently say this: confusion around mortgages, lending rules, and long term financing strategy is one of the biggest sources of stress for clients today. And I get it, guys, like rate shifts, guidelines change, headlines right now are pretty alarming. And too often people are forced to make major decisions without truly understanding their options. And that's exactly why we host sessions like this, so that you can move forward with clarity rather than uncertainty and confidence rather than pressure. So today we're going to be focusing on your financing roadmap from first purchase to renewal. So everything in between. And there's a lot of information to unpack. We're going to be walking through what first time buyers need to know before entering the market, why pre approvals matter more than ever, and how to think strategically about renewals and refinances. And what current lending trends actually mean for you, not in theory, but actually in practice. And so I'm really fortunate to be joined by Jordan Lee of the Vine Mortgage Brokerage. Jordan is a trusted mortgage professional we regularly collaborate with, somebody I respect deeply for the way that she educates, explains complex concepts, and really just help families make really good decisions. That was tricky, Jordan. I feel like I'm stumbling over my words. Um, and so tonight's session is really designed to be practical, approachable, and hopefully informative. And just before we begin, quick housekeeping note: this call is being recorded, and both the recording and tonight's slide deck will be shared with you afterwards. We're also going to be doing some live Q&A at the end of the presentation. You're welcome to ask questions about real estate financing or the broader market during that time or privately afterwards. The agent who invited you this evening will be reaching out to you following the session. And as always, we're happy happy to continue the conversation or connect you with the right resources. So thank you again for being here. We're grateful for the trust that you place in the agents that are part of our brokerage, and we're excited to spend the next hour with you, giving you some tools, insight, and perspective. So, Jordan, let's get started.
Thank you for an amazing intro. I'm just going to pull up my shared screen so I can get the presentation going for everyone. Just give me a moment here. And I just want to say thank you so much for also just having me in general. Carol, it means so much to me. And I really do. This is going to sound so cheesy and cliche, but it really does feel like the most important part of my job is the education part of things. It is such a potentially overwhelming process. And the reason it's overwhelming is because the unknown causes anxiety. And for a lot of people, the home buying process is a huge unknown from all angles. And that's just because we unfortunately don't get taught this. Nobody sits us down, not in school. Very rarely, I think, in a lot of families, are we sat down to have this conversation of like, how do I buy a home? What do I need to do that? So I really it's truly where the passion comes from, is because I think when I can see that moment in clients where it clicks and it changes from discouraged to encouraged and seeing a plan and a goal in place, like that just means everything to me. So I'm very, very excited to be doing this for
And
everyone.
Jordan, there's going to be people on this call who, are 5 years away from being homeowners. There are people who are 5 years away from home ownership on the other end and will be looking to downsize and do something else. So we're really going to be talking to a huge spectrum of people tonight. But you're absolutely right. I think this is a time where headlines are just so attention grabbing, but there is, I mean, I'm hearing it back on the real estate side, so much misinformation. So clarity, I think, is the goal for tonight for everybody.
Totally, totally. And can I just make sure I'm sharing my screen? Can you
You
see the
are.
Zoom blurb by any chance? You can't see that, right?
No,
With my
you're in presenter mode, so you're good, Jordan.
Okay, perfect. Thank you.
Awesome. Let's go. We've done a lot of these. I feel like it's second nature to us, right, Jordan?
I
You've
know.
been educating our clients for a long time, which I'm grateful about.
Me too. Thank you. And I'll do a very quick blurb about myself. You really gave the breakdown though, but just so people understand what background I have, is that my background actually started at the bank, Scotiabank specifically. I did a couple years in wealth management before I moved over to the mortgage side within Scotiabank. So I've done mortgages within the bank, and then I decided during the pandemic to move over to the broker side. And that was primarily because I needed to be able to give my clients options. I didn't make sense to be stuck with one bank,
Mhm.
because what that meant is essentially at the end of a conversation with any client, I'm going to refer to Scotiabank. That's all that I have in my pocket. But being able to listen to my clients' goals and needs and then be able to be flexible and find the right fit and customizable solution, main reason that I came over to the broker side. And I mean, I don't think most else is important, but really, truly, again, I just want to highlight that the passion comes from being able to help clients achieve those goals. And kind of like you said, there are so many conversations to be had. And my goal is to make it as approachable and feel not intimidating, because these starter conversations is where like all the magic happens, because I really feel clients get so overwhelmed that they even stop themselves from just reaching out to us to start that conversation, to figure out what their starting point is and ask the questions directly, because it's so easy to psych yourself out from the unknown.
And Jordan, you breezed over the middle part of your slide here, but I just want to highlight, Jordan, like the reason why you're invited to speak to our clients is because you do come from a place of service, obviously, but you are doing a lot of mortgages for a lot of different scenarios. And so you're going to be able to speak confidently and competently about lots of different types of financing. And I mean, we could have a seminar that went on for 8 hours tonight. Don't worry, guys, we're not going to, but we certainly could. And so we're going to talk high level about a lot of stuff here, but if there's something very specific or you didn't quite understand, of course, Jordan, you're going to be available to chat with people after the fact. But yeah, doing high level mortgages for a really long time. And you're not just licensed in Ontario, is that right? You can actually do mortgages in other places in Canada as well.
That's right. I can do mortgages all over Canada, so any province within Canada. And yes, I did kind of go over the second point, the middle point there, but I am grateful to have seen over $2.5 billion in residential mortgages in my past 10 years of mortgage career. And that included when I was at Scotia, doing about $500 million of residential mortgages annually. So I feel confident that I've seen almost everything under the mortgage sky that there could be. And I'm grateful to be able to have those experiences. So that is what brought me to here today.
So let's
So
talk about all the things, Jordan. Mortgages, fun, not fun. You seem to make it engaging anyway. So let's talk about some terminology. I love this.
okay, I'll try to make this part. This part is not as fun, but it is something I want to go through before we
We'll
jump
go
in.
real quick because I know for some people this is going to be pretty old hat, but let's go through it real quick.
These terms are going to be brought up a bunch during either presentation or through the conversation of a mortgage with a mortgage agent. So just want to make sure we have understanding of course, down payment is what the amount, dollar amount or percentage that you're going to be putting towards the purchase price of the home. Down payment is not inclusive of additional closing costs. It's simply what's going towards the purchase price. Your equity is the difference between your home value and any loan outstanding against it. That's what your equity is. This one is important because this is going to come up a lot in the renewal refinance section of our conversation. HELOC. A lot of people say the term, but they don't really know what it means. And a HELOC just simply stands for a home equity line of credit. So other words you might have heard for it is secured line of credit because it's secured against the home. Every bank has a different name for it. STEP, home line, ready line, flex line. They're all the same thing, just every bank has a different name for it. And that's a secured line of credit.
And so a secured line of credit, meaning that it's registered on title behind the first mortgage of the house. So you've got your primary mortgage and then you've got your HELOC registered behind it.
Correct. You can actually also just have a line of credit on the home itself. You don't even
Mhm.
necessarily have to have a mortgage
Oh,
component.
fair enough. Yeah, no, yeah, correct.
So we can
Great.
do that. Amortization, the length of time it would take to pay off your mortgage in whole. But what that's really dictating is your payments and also affordability, helping with affordability.
Mhm.
Mortgage term is just the length of time that you are locking in your interest rate for. High ratio mortgage, that is synonymous with an insured mortgage when it's less than 20% down. And a conventional mortgage means uninsured when you are putting 20% down payment or more. So you'll hear those terms interchangeably. Open versus closed mortgage. I get this one a lot. People will ask if it's an open or a closed mortgage term. Generally speaking, any mortgage term you're getting is a closed mortgage. What that means is that there's a penalty to pay off the mortgage if you were to pay it off. An open term mortgage, very unlikely that you're going to take it. In that scenario, you're taking it because you know you're going to pay it off in a short period of time, essentially. And you would do that in case you know, like, for example, I got off a client call today. She's coming up for renewal soon in the next couple months, but also wants to list to sell. She's someone who might want to go into an open term mortgage so that she can pay off the mortgage upon renewal with no penalty since she knows she's going to be selling. So that's high level, some mortgage terms that we're going to bring up through this conversation.
And I just want to clarify for a minute, Jordan, because what I'm noticing a greater and greater prevalence of is the introduction of American mortgage or American real estate terms. And part of that is because, of course, as Canadians, we are absorbing a lot of American media. So I hear people talk about being cash buyers or sale price per square foot or all of these things, which tend to be very American driven. And I've also heard it now in a lot of the mortgage conversations I'm having with people. So just something to be mindful of, guys. If you are going to, ChatGPT or Reddit or the internet in general, when you're looking for information, it's really important. In fact, one of the questions that we got today was specific to an American perspective. So it's just really, really important that you be sure that the source that you're reviewing is a Canadian source because our mortgage landscapes north and south of the border completely, completely different.
Yeah, I really appreciate that comment because it happens at least probably weekly where I'll get sent an Instagram reel or a TikTok with some piece of advice and the client asking, is this true? Or, something like that. And it's oftentimes exactly what you said, actually. It's true, just not for us. It's usually American data. So you always want to fact check that through one of your trusted advisors that work in the Canadian real estate space.
Yep,
So
got it. Yeah, Instagram, right? Like it's just we're sharing the reels. It's great for sharing information, but sometimes not applicable. Okay, so first time buyer, home
okay,
buying.
so exciting part. So this is the benefits. To be a first-time home buyer, this is what you get to be in terms of the benefits. So the first is the RRSP withdrawal limit. So something you might notice is that it's up to $60,000 per person, which is an increase from the previous 35. So that is something that the government has done in terms of social policy to try to incentivize and help first-time home buyers get access to a down payment. So each applicant, by the way, something I want to specify is if you have two first-time home buyers on the purchase, each of them gets to take out the 60,000 per applicant, not 60,000 combined. And you also, though, with this withdrawal, there's no immediate tax implication, but you do have to pay it back within 15 years. That repayment, though, is interest-free, but you do have to recontribute it back to your RSP within 15 years.
So, Jordan, I know that there's going to be people on this call that are here for the refinance or the renewal part of this. I really just want to highlight, guys, pay attention to what's different because there is a really good chance that this information has changed since you became a first-time buyer, and you're going to come into contact with people in your life, whether it's, adult children, coworkers, friends who are not on a path to home ownership, and it's because they don't have correct information. So, really, just take note of this, guys. It's changed since many of us bought our first homes. And it's really important and relevant information that you can share with other people in your life.
Exactly. And this one we haven't seen a change on, land transfer tax rebate. That one means depending on the province you're buying in. So let's speak about Ontario though, since we're in Ontario, you would be eligible for a first time home buyer land transfer tax rebate. The word rebate here, it's really like a discount. So you're getting it off the top.
Mhm.
And when you're purchasing in Ontario, it's a $4,000 up to a $4,000 rebate. When you're purchasing inside the city of Toronto, it's up to 8,475 because Toronto is the only city that charges a double land transfer tax, a
Yeah, so it's
municipal.
not that the rebate is bigger, it's that you're paying more taxes. So there is a secondary rebate, but there's still going to be more taxes.
Yep, it's relative to the actual land
That's
transfer tax
correct. Yeah.
itself. Tax credit. This is one that I actually don't hear a lot of people talk about, but a really handy one is you claim up to $10,000 on your income tax return. So you'll file that with your accountant for the year that your first home purchase closes in. So
Mhm.
I think the reason we don't hear about it is probably sometimes maybe accountants forget to ask that question, clients forget and don't know to ask their accountant that question. So it's a really important one to highlight in your mind because your accountant doesn't technically always know if you've purchased a home, so they won't file that tax credit, and that $10,000 tax credit can save you money.
Quite a lot. So imagine that you're at, say, like a 40% tax bracket and it's a $10,000 credit. You could be saving an additional up to $4,000, right? Which is money that comes back to you through your income tax return. So really important. But you're right, Jordan, a lot of people do not talk about that.
Yeah, it's forgotten a lot and a big one. And then the last, this is one that changed. So 30-year amortization, that is for insured mortgages, less than 20% down. Previously, you could only go to a maximum of 25-year amortization, but now in the last about year, we're allowed to go up to 30-year amortization when it's an insured mortgage, but it has to be a first-time home buyer. So if you're not a first-time home buyer and you're putting less than 20% down on your purchase, your maximum amortization stays at 25 years. Now, if you are putting 20% down payment or more, doesn't matter if you're a first-time home buyer or not, you always will get access to the maximum 30-year amortization.
Got it.
Okay, so those are the first-time home buyer benefits. Now, I don't know if anyone is thinking about this on the call, but one thing I thought about bringing up, and I'll bring it up, is just if you've noticed there's one missing, and that's because this first-time home buyer incentive was removed a couple years ago, which is the one where I still sometimes get questions about it. But if you've heard about the first-time home buyer incentive from the government, that was when they helped you with the down payment and did a shared equity approach on the property. I just
Mhm.
want to make sure everyone knows that that has been removed from the government. They don't do any down payment assistance anymore. And I do still get questions about that. So really important to know there is no more government down payment assistance program where they do a
And
shared
to be
equity.
clear, it wasn't like if you really dug into it, it was an underutilized program, but also not particularly advantageous for the homeowner. Essentially, without going too far down the rabbit hole, just so that you guys know before you feel like something was taken away from you, it basically and Jordan, you can perhaps describe it better than I could, but effectively, if they were contributing 10%, then they were now a 10% stakeholder in the value of your home. So it wasn't a 10% loan to you that you paid off. It was a 10% partnership. And if the value of your house increased by, say, 50%, so too did the interest that they had in your property. So it wasn't particularly popular for that reason. So if you didn't take advantage of it, you probably didn't miss much.
No, you're exactly right. I think in my 10-year career, I've had one or two clients use it for that exact reason is it's a shared equity approach. It's not an interest loan, like a typical interest loan. It's actually based off of the equity and the appreciation. So it defeated a lot of kind of the goal of being a homeowner in that program. So not a lot
Got
of
it.
people utilized it.
Hmm.
Just mentioning it in case anyone was looking for it, why it wasn't there. Now, the last big change that we've seen is the first home savings account. Not new. I mean, it's come out in the last couple of years, but new, relatively new. Why this one is a big deal is because unlike the RRSP, you don't have to pay it back. If you remember, I said anything you take out of the RRSP, you have to recontribute it back within 15 years. This one you can actually take out and not have any repayment to deal with. So the pro tip you'll see that I noted is that oftentimes what makes the most sense for clients to do is transfer $8,000 from their RRSP into their FHSA because that's the annual contribution limit to be able to essentially liquidate. You're kind of freeing up an extra 8,000 from your RRSP and you still get to use that 60,000 from your RRSP. The reason this comes up a lot is because most people, or a lot of people, I'll say majority, have a majority of their investments and their assets kind of stuck in an RRSP. So it's just a way to be able to funnel out a little bit more money from it tax-free. Alternatively, you could, of course, use your 8,000 annual contribution and just invest straight cash and new money into it. But in case you're just trying to actually optimize your RRSP, that's a great way to access more money. Other great things about the FHSA First Home Savings Account is any investment income in it is tax-free while it is in that account. It allows you to, of course, again, withdraw the money without any taxes. The biggest limitations are those last 2 points there. $8,000 annual contribution and $40,000 lifetime contribution. So it's not a whole lot you can, in theory, invest into it, but I do think it makes a difference, especially for that kind of RRSP to FHSA loophole. So definitely one I see used a lot.
And guys, I just want to be clear, if you're already lost in the acronyms, you're not alone. This is complicated. Even real estate and people that are heavily involved in real estate get down a rabbit hole of this. I want to be clear. If don't feel overwhelmed by this. Jordan or a mortgage professional of your choosing can sit down with you and walk you through what applies to you, what doesn't, and look very specifically. Like, don't think if you don't have a first home savings account, you can't buy a house, or if you don't have RSPs, you can't buy a house. Not the case. So, just a reminder, guys, we're talking high level here today. There's going to be information that's very specific to you that you can share directly with a mortgage broker.
Yep, exactly. And this actually is probably going to prompt more questions than anything, which is awesome
Mm-hmm.
in itself because we can actually we can have that conversation offline and I'm happy to go through any like specific questions, help you guys out through next steps there. But
Mm-hmm.
first thought is where do we start? So now we are starting to think about purchasing. So we are first-time home buyers starting to think about it. And our first step is always going to be the pre-approval. So the pre-approval is so important because this is what tells you what you qualify for. I really want to highlight this first point I have here, which is all documents up front. It seems like I hope that that isn't an intimidating statement because I actually just want to take literally maybe 30 seconds to break down what all those documents are. I'm just going to say it for a full-time employee, um, employees. And the reason being is because if you're self-employed, the documents can be a little bit different and we have to do specific to your case. But for the general population that is employed, full-time permanent status, it is your photo ID and 5 income documents. And that is just a letter of employment, 2 years T4s, and 2 most recent pay stubs. 5 documents plus an application. That is going to get you your pre-approval. Clients will often ask, can we not just do it high level? Can I just give you some numbers and then you can tell me what I qualify for? I will honestly often say I don't recommend it. And the reason being is because this is your biggest purchase in your life. It will also be one of your biggest debts in your life. I believe that it is worth the 10, maybe 15 minutes to put together the application and the documents because The numbers that we use and the bank uses are often different than the numbers that you kind of have in your head of your income or your debts or what they're using to qualify. So this I need to highlight because I have never seen it more in my life with buyers who use online tools, or I'll even say banks that do these high levels, don't ask for any documents, no application. And at the time of purchase, the numbers aren't what we want them to be. So I cannot.
It's that, yeah, Jordan, it's that term. And I hear a lot. I say, are you pre-approved? They're like, well, we're pre-qualified. I'm like, okay, not the same thing. Pre-qualified, you might have gone online. You might have like entered in a few numbers. They've spit out a general, amount that you would likely, or you could be qualified for. It's meant to be a hook to get you into the bank to get pre-approved. And so to be clear, guys, when I'm a real estate professional, I have somebody that, comes into our office or presents themselves as ready to buy a home, whether it's a 10th purchase or a first purchase, it is really important, the pre-qualification, because that is where the bank is actually reviewing all of the documents and then giving you a firm commitment based on those documents. And if they have questions or they need clarification or they need additional documents, the time to do that is upfront.
Yep. And I'll give you guys an example, just a very basic one of a client who needed a pre-approval. They went to their bank, they got it done. It was even done on letterhead. Great. It was done by one of the big banks. Their realtor wanted me to have a second opinion. Don't know why. They just had a feeling to have a second opinion. I do the application, I do the assessment, and the affordability is lower than what's on the CIBC commitment letter. Like, I mean, it's on, oh, I shouldn't have said the bank, but anyway, I did. It was on bank letterhead and it had a certain number on it that was higher than what I came to. Essentially, through looking through their letter from the other bank and my assessment, it was that the bank forgot to include condo fees on the assessment. And this is what I mean of the thoroughness and the accuracy and every little detail that counts when we're talking about getting a pre-approval that often gets overlooked by other people or technologies that can't factor those things in. So it's so important to use a trusted advisor, whether that's someone you're close to, whether it's someone your trusted realtor is close to, but make sure you are getting that full pre-approval done. I think it's the biggest thing that I can highlight in this conversation. The second here with pre-approvals, why it's important, as I mentioned, is of course it's going to dictate your maximum buying power. Often people have in their head kind of what they think they want to buy or what their goal is. And oftentimes when we do the assessment, it can come in maybe on target, but sometimes lower or higher, which changes the direction you might go in. So it's extremely important to understand where our numbers land, and not just from a buying power perspective. What we go through in the assessment details is also payment scenarios, and that is crucial. A lot of banks, they don't go through payment scenarios with their clients. We need to make sure that, yeah, the purchase price works for them. They can find a property at that price point, but two, they can afford those payments that come with it. Housing expenses, mortgage payments, condo fees. We go through all of that. And that's really important to make sure they understand their full buying power from all angles. Rate
Mhm.
hold, a little less important, I'd say, in this market. And the reason I say that is specifically just because we tend to get the lowest rates in this environment when we have an accepted offer, because everything is based off of rate exceptions. So a little bit, we can still absolutely do rate holds, always available. But I will say that when it comes to fighting for your best interest rate, it will happen at an accepted offer. That's been the way the market has been for the past few years while we go through this extreme uncertainty of interest rates right now. They have to do it kind of day by day, price things day by day. Efficiency, I'll mention as it's really in the process, because as we know, it can feel overwhelming to go through the whole home buying process. So we want to be able to check this off your plate early, have the pre-approval done. So once we have the accepted offer, there's very little for you to do on the back end. We want you to be able to enjoy that moment, to not feel overwhelmed and rushed during that moment when you're going through the offer, getting the accepted offer. And so maximum efficiency is really where that lands, is at the time of accepted offer. It's very smooth sailing because we've already reviewed everything, have most of your documents up front. So pre-approval, key.
And Jordan, I can't tell you how many times where people kind of kick the can down the road to getting a pre-approval. They find the house, it's perfect, and they can't move forward with it because they don't have a pre-approval, or getting the job letter, or they need something from CRA, and it's going to take 6 weeks for that document to come, and they simply can't move forward with it. So do it early, guys. There's no cost associated with getting yourself pre-approved. It doesn't affect your credit score by getting pre-approved. It is the single best step that you can take to start the home buying process is getting a pre-approval. And if you never use it and you don't end up buying now, it expires and there's no big deal. It just goes away. And so there is no downside of getting a pre-approval.
Yep, that's what I say too. And again, even to that point, there's no bad starting point. Even if we do the pre-approval and we're not meeting the goal that you had in mind in the initial conversation, that's okay. That gives us a blueprint to start to talk through how do we get to your goal, whether that's a 1 year plan, 2 year, 5 years, whatever it may be. There's no bad pre-approval, no matter what the outcome is. It's only getting you closer, us closer to your goal. That's all.
Got it.
So pre-approvals, we're going to get that done. And then I believe we're going to talk about down payment. So here I have a chart just to give you a visual of some samples of what a minimum down payment looks like. So to break it down, what a minimum down payment is, it's 5% up to the first 500,000 of a purchase price and 10% for the difference up to 1,499,000. Oop, there's one extra nine in there, 999. So sorry, ignore that last nine in that.
I
And then
like the Jordan, I like the oh yeah, lots of nines. I like the graph because this is where people sort of get lost in the weeds. And I can't tell you how many people who are first time buyers like, well, I can't buy yet because I'm trying to get to that 20% threshold. No, you can buy at any point with 5% down. There's just limits and criteria around it.
yep, exactly. And so, and I think this chart just makes it digestible, kind of to your point, for people to understand price points that are happening, which we know there are price points at that lower scale right now. And maybe it's a lot less intimidating to see, okay, to get into that starter home, I would need to save $25,000 as opposed to looking at the bottom of the chart, which might be the thing that's in your head before the conversation is like, no, I need to have 300,000. It's not the case. It's not the case at all.
And
So,
you know what's also changed a lot? We're going to talk about this later in the presentation, Jordan. But you know what you can buy for 5 and 600,000. Like there was a time when we would show this chart and people say, "Well, what am I going to live in a 400 square foot bachelor condo downtown with no parking?" Like that's the only $500,000 option. The reality is now is that in the greater GTA, there are now homes that have fallen back into the 500,000s. I get a weekly email from one of our partner agents here at Signature Elite with all of the homes available just north of the city for $500,000 or less. And within the Toronto market, we are now seeing like family-sized condos and townhomes that are back in the 5 and 600,000s. We had a detached 3 bedroom, 2 story that recently sold just east of the downtown core for 670,000. And the house was in, I won't say great condition, but it was certainly livable. So guys, if you're looking at these numbers and saying like my down payment doesn't align with where I think I need to be, I would say in addition to clarity around this, you also need to speak to a real estate professional around clarity about what stuff is actually selling for in this market. Because what was true even 12 months ago is now no longer true. Many of the neighborhoods and the asset classes that you thought might be out of reach have now probably fallen bang into your affordability range.
yeah, that's huge. That is like so
Huge.
worth it.
Jordan, we have a great 2 bedroom condo right now available, $375,000. And it's like 900 square feet, really livable space. Like, buy me somebody. So, great
That's great.
starter point for somebody or a downsizer, right? So,
Yeah, no, it every time I hear these like these huge crazy scenarios, like it honestly makes me wonder why I'm not personally on the market. It just seems too hard to ignore what's happening out there. But anyway, continuing with the down payment, I do have a couple additional oh, I thought I had down payment first. Sorry, closing costs. We'll go closing costs first. My computer is lagging. Just wait for it to catch up. Okay, so closing costs. Closing costs are what is needed in addition to the down payment when you are closing on the purchase of your home. The closing costs are not needed technically at the front end of the purchase. It's needed when you're actually closing. So closer to a couple days, I'd say a few days or a week before your closing date. So the land transfer tax is one that we already talked about. It's calculated based off of the purchase price and the city that it's in. Legal fees, that's your lawyer fees, as you'll need a lawyer to close and register the property and the mortgage. And
And
then
to
you
be
have
clear on the legal fees, I just want to touch on that because people hear lawyers and they're like $500 an hour. Like, no, guys, we're not getting Johnny Cochran to defend you in a capital murder case. Typically speaking, the lawyers involved in a purchase transaction, I would say the average that I'm seeing, Jordan, is somewhere between $2,000 and $3,000. So, and because it's largely transactional in nature, so I would say you don't want to go the cheapest option. There are lawyers out there that'll, charge you like $999, but it's usually not a lawyer that's touching the file until closing day. And you also don't need to hire like, your mom's Bay Street partner to do
Mhm.
this either. So there's a happy medium there, guys. And I'm going to say a budget of $2,000 to $3,000. And that goes for, second, third purchases as well, too. It's usually not an incrementally higher cost if there's a buy and sell. So if you're selling your house and buying it, it's usually not double scale for that. Usually there's a cost that is less than the double value of two transactions as well. So if you're watching this and you're thinking about a home transition, just be mindful of that as well too.
And yeah, 2 to 3 is actually exactly what I use in estimate scenarios. So 2 to 3,000, that's perfect for legal fees. And then the et cetera, as you see here, it can include a couple smaller things. As when I go through actual payment scenarios with clients and closing cost scenarios, I'll usually total that other section for a grand total of 2,000, unless there is a penalty to break a mortgage, then that might be a little higher and include it. But all of the other things, moving costs, home inspection, appraisal, I'd say we buffer an extra $2,000 to $3,000 for that at maximum. Again, just depending what we're including there. So
Now,
that's your 20.
sorry, the one thing that's not on here, and I want to just highlight it because again, and we could have a whole master class just on, the real estate side of working with a realtor. To be clear, guys, when you're working with a real estate professional, you as a buyer and as a first time buyer in particular, you are not compensating that person directly. We are being compensated by the seller of the property that you choose to buy, even though we owe fiduciary responsibility and legal obligation to you as our client. So to be clear, if you think that there's a cost associated that's going to be directly payable by you as the buyer, the answer is in almost all cases, no. There are, off market and a handful of very, very obscure times when it might be, but you would know that going in forward ahead. And honestly, in my entire real estate career, that's happened only maybe two or three times in very specific circumstances. But partner as early as you can with a real estate professional who can explain to you this home buying process, and know that we don't get paid by the hour, we don't get paid by you directly. We are here to walk alongside you to try to get you the best deal possible and give you the best information that you could possibly need to make a good decision.
And on that note, I should add, because I actually do get that question as well, is how is the broker paid? Because a lot of people don't understand how I myself am paid, and I am paid directly through the lender. So there's also no payable costs from the client itself, whether in my case, first time home buyer or not, multiple buys, investor, whatever it may be. My cost is paid by the financial institution itself. And again, there's like in Carol's case, there's very few exception scenarios where there would be a lender fee, and that is we're talking more alternative and private financing solutions. So we're not talking about your more standard
But
purchase.
Jordan, doesn't that mean, I'm going to play devil's advocate here, doesn't that mean that your lender fee just gets tacked onto the mortgage and I end up paying more? Like, let's talk about the advantages of working with a mortgage broker. And I apologize if you have a slide for this later on and I'm jumping the gun, but I do, because Jordan, like I would consider myself fairly well versed in mortgage financing. I work with a broker because a broker is going to negotiate the best possible rate on my behalf. I work with a broker because they're going to give me information on all the products with all of the lenders that they work with, not just the bank that I'm currently in relationship with. So even as somebody that transacts a huge amount of real estate, I am constantly leaning into my broker connections to be sure that I'm getting the best deal possible.
Yeah, and I do have a slide at the very end, just kind of why you would go broker over banker. But I'll say this is actually funny that you bring this up. Is it was actually, I think it was one of your clients that I was just on a call with this evening, and they actually compared me to Trivago, is what they said
Oh,
that commercial where it's like, did you check Trivago? So like, I think the thing is, and why I share that sentiment is because in so many other industries and spaces, it's normal to use broker type services. I think gone are the days where the trust is within the bank and you're walking into the bank and you have this trusted advisor that you've built this relationship with. That's just generally not the case anymore. When you go into the bank, most people will say it's new faces every time I'm in there. The turnover is, I can't even build a relationship before the next person is gone. And I think that's the difference where I won't speak for all brokers, but certainly myself is this is career driven. You will always know where to find me. You will always have access to me, whether we're doing your first mortgage or second, or just doing maintenance between the two. It's having that relationship, someone you can call to get advice, no matter what the situation is. So I think that's a huge thing. And we've been talking about this a lot on the broker space, is there is a very big shift happening in the past year, 2 years, where there's been about, I think, don't quote me on these stats, but I believe it used to be closer to 15% of clients that use brokers. And we're going into, over just the last couple of years alone, to 40 to 50% of clients using brokers, meaning it's not just me who sees the value. It really is, I think, a shift in this whole industry. Because if you think about it, insurance is another great one. No one really knows where to go to call. Like, who do I call to get insurance? There's an insurance broker who's going to shop that for you. Because why would you take your time to call every insurance guy and be like, hey, here's my situation, here's my application, give me a quote. Do that 10 times over. That makes no sense. That's not efficient at all. That is where a broker comes in and we're able to do that shopping for you. But not only that, I think the shopping is one key thing. I really think it comes with the experience and the knowledge and the education piece again. I think that is really where it has to be highlighted. Rates, for sure. Yeah, we'll shop all that, we'll shop product, but the non-obvious parts is the client experience that you get.
Yep. Got it.
And now moving back, I think we're going back to down payment here if I'm correct about these slides. Yes. Okay. So this can technically be for down payment and closing costs. I'm just giving an example of what your down payment and closing costs can consist of. So of course, it can be savings. So what you're putting towards from your own funds, that's RRSPs, TFSAs, savings accounts, any of your own assets. One thing a little error there too. Be mindful is the word I was looking for, mindful of any maturity dates. And the reason being is because I noticed that not an investment advisor, but definitely something must have happened in the last couple of years because I have a lot of clients who are in locked in GICs. And so why that's important to note is you need to be sure about your maturity dates on any investments you have. Make sure you double check with your investment advisors when those are coming up, because some of these kinds of assets have maturity dates that you cannot liquidate before that date. Did you have a note on that, Carol?
No, I was just going to say, to that point, we get a lot of clients if you're banking with a non-bricks and mortar bank, so you're with like a Tangerine and you need to pull money out for certain like a deposit or a deposit on a purchase. Make sure you understand what the criteria is around how long it takes, because typically we've got to deliver after an offer is accepted within 24 hours. So be sure you know what the liquidation process is around your investments when you pull them out.
Yep, and I'll go over that as well too a little bit more. Gifted funds, that's a big one that gets used, totally acceptable by most to all lenders. Now, it typically has to come from an immediate family member, and by definition, that would be a parent, grandparent, or sibling. But we definitely have had exceptions to, outside of that being aunt, uncle, friends, not so much. It has to be reasonable. There has to be a business case to why somebody, like a godparent, that has happened before too, but it has to be reasonable to why someone would be giving you a pretty large lump sum of cash, essentially. Important to note that if any funds are coming from international, which does happen, we need to make sure that they are within Canada a minimum of 30 days before your closing date. So if there is international funds, I always recommend just get it here sooner than later. You don't know what can happen to that money in transit. Just get it here. And can't be from, so closing costs and down payment can't be from unsecured debts. So unsecured, meaning it's not secured to any home. And examples of that would be credit cards, lines of credit, unsecured, and bank loans. That can't be a source of your down payment. The only time an unsecured debt can be used, by the way, and it does come up, is if you needed a buffer period to get that deposit that Carol mentioned, because you have your assets invested somewhere or in one of those banks like Simply or Tangerine. You can use your unsecured line of credit to put the deposit forward, but you will have to pay that deposit, line of credit back down to zero. So it's
No
just
crypto.
No
No
crypto.
crypto?
This is big.
Jordan.
This is big for my generation. Well, it's not really mine, the one underneath me, but that is huge. No cryptocurrency or cash. And I say this um, because I have had clients, unfortunately, in these circumstances. And why I say unfortunately is just because it can sometimes we need to liquidate those funds ASAP, is my point essentially. So let's chat about it offline if you're one of these people. But the reason cryptocurrency doesn't work for most lenders and definitely all the big banks is because the point that the big banks want to see is they want to paper trail all your money, all the money that you're putting towards the home. They want to see where it all came from. Kind of the not the point, but one of the things of cryptocurrency is that it's not traceable, right? So it goes against the bank's whole objective of tracing funds. So it's not applicable. The reason cash isn't applicable either is because it's, again, non-traceable funds. So these two types of funds, I recommend liquidating or depositing into your regular cash account as soon as possible if you're thinking about buying.
And it sounds like an oddity, like, well, who would have cash? But I want to be clear, we do work with people who work in, the trades, who end up with a mattress. I've literally had someone show up at my office with a cooler full of cash to try and bring the down payment that way. It's something to be mindful of. So if you are in a cash, heavy industry, you do have to speak to somebody about how to get that money into the bank, and you're not going to be able to do it off the record. I will just put a point because this has come up a lot more now that we have younger generations in particular. Crypto, obviously, we're not here to talk about the pros and cons of it, but the reality is it is hugely volatile, regardless of whether you're pro crypto, anti crypto. It can be worth a lot one day and not a lot the next day, and a lot again the following day. And why this is important, guys, is because when you are looking to secure a real estate transaction and you are anticipating that your crypto is going to be worth $100,000 next week, and then you go and put in the offer, and then something happens in the world and crypto collapses that day, which happens multiple times a year. You need to be sure that that money is there, because once you signed an agreement, the cash has to be there. So if what we're going to do is we're going to take the money out of our crypto and we're going to put it into something safe and non-volatile while you're out shopping for a house. Super important, guys. I would also extend this to certain investments within the stock market as well. If you are invested in heavily volatile funds, you need to move it into something that is safer. Doesn't mean you need to lock it into a 5-year GAC that pays no interest, or very little interest. But what you do need to do is ensure that there is stability in the value of those investments while you're shopping for a house.
Yeah, 100%. That's exactly what my financial planner told me when I was home shopping is he said, you need to liquidate that now. If you know you're going to use it, how is it worth the risk that, yeah, it might go up 5%, but how about if it goes down that 5 or 10%? That's money that you need. There's no point in taking risk with that kind of money. And cash, another thing I want to add on, Carol, quickly is just that beyond cash jobs, another situation that comes up a lot is weddings. That is where I personally see a lot of cash deposits come up, and they're like, well, I just received like 20K, like, and it's literally to buy a home for my wedding. Like, what do you want me to do with that? The first thing is always getting that cash into the bank, because that is you at that size, you might even have to fill out a form at the bank to get that money into the account. And then we need it to sit there for a few months so we don't have to paper trail it, because we still can't paper trail it even though it's been deposited. So we can talk case by case on that, but that is a big one that comes up as well,
Wedding,
weddings.
yeah. It depends. Some cultures, the wedding money is a big deal. We could be talking about hundreds of thousands of dollars. I clearly didn't marry into the right family, Jordan. I'm just kidding. But I'm still waiting for my wedding gift from my brothers. If you're watching,
It's
you
funny.
can write a check, guys. Okay, so be prepared with your deposit. Really important. Minimum of 5% of the purchase price.
Yep. So you kind of touched on that, the 5% of the purchase price within 24 hours. Now, why this is important to highlight, I make it its own slide, is because of the things that you mentioned. So the delays that can happen are accounts types or banks that don't have branches. So you can't walk into it and ask them to make a draft. I think, Carol, you and I have seen enough clients that bank at Tangerine and Simply to know it takes at least a few business days to get that money, one, liquidated into somewhere that they can, and then they'll get you a draft done. It's a long process. And then, you got these investments that need to be liquidated. That can take about 3 to 5 business days. But the main thing that I need to highlight is the fact that the 5% needs to be liquid within 24 hours. You need to be able to get that draft. And where that kind of gets a little bit tricky for some clients is a lot of clients for first-time home purchases, their assets are in the RRSP and the FHSA, so the registered savings plan and the first home savings account. Well, the thing about those accounts, it's very important to note this up front, is you cannot actually liquidate those accounts before having an accepted offer. So that means that you can't technically use those funds for your deposit, that 5% that you'll need with for your accepted offer. And that comes up a lot. So that's why I mentioned some people will use a line of credit. Some people have other asset accounts like TFSAs or cash accounts that they can access quickly. But if your money is all in RRSPs and FHSAs that you're using towards your purchase, this is something we have to note to make sure we can find access to 5% of your purchase price for your deposit funds. Okay, so that's something that comes up a lot. Now, interest rates is one I'm going to talk about at a high level, just because, of course, in this interest rate environment, it's so specific case by case and day to day, more particularly to what's happening in the market. Here I'm showing you the general interest rates that people will choose in Canada. Why I say that is because some mortgage lenders have 7 and 10-year terms as well, but I've almost never seen anyone take that. I've had one American take a 10-year fixed term in my career, and that's because they're used to longer term mortgages over in America. But this is the standard, 1 to 5 years. Starting with your 1 to 2 year fixed, these are the shortest terms that someone would choose, but they're also going to come with the highest interest rate premiums. So most people don't choose those unless you have a very specific goal, like you're going to be selling, moving, or you want to reevaluate your goals and plans sooner than later. You might choose a 1 to 2 year fix, but I honestly haven't done those in a while. The 2-year fix was important 2 years ago when I was advising clients that we would, of course, see interest rates come down soon in the near future. And so we wanted to get them into a 2-year to renew sooner than later to get them access to today's interest rates. Because remember, we are coming from 2 years ago, interest rates being in the 6% range. Like, I'm not even exaggerating that. When I was putting this presentation together, I was looking through what the interest rates were in 24 and 25, and that is where we were in the high 5% to 6% range. Crazy back then. Back then, that was only 2 years ago. 3-year fixed I find is a sweet spot for a lot of clients. And that's because it comes at an attractive interest rate. It will be lower than the 4 to 5 year fix, and it is a fixed rate. So it gives people some kind of security and stability over the next few years. The 4 to 5 year fix, those are going to be your highest interest rates today. Those do lock you in, though, for a longer stability and predictability during this time. And the 5-year variable gives you the most flexibility. So just want to break down a few things about that. Your 3-year fix, going back to that. So when we're looking at the fixed terms, you have your short-term fixed and you have your long-term fixed. Ultimately, today in this market, really what the fixed is providing you and why you might lean towards a fixed is if you want predictability and stability in your payments. You know that you don't plan on moving in the next few years. You don't need variance. You don't need flexibility. You need stability. You want to lock in your rate. You want to lock in your payment and just coast through the next few years because you don't have to worry about what's happening in the news, what's happening internationally. You just make your payments as is. Now, when we consider that, yes, the 3-year fix is going to be your lower rate. And that is oftentimes, just kind of pivoting into the renewal space, is what I hear every time a client comes to me with a renewal. They are quoting me the 3-year fix. And I have no idea why they want the 3-year fix, but it's not that. It's that the bank wants to sell them the 3-year fix because they're always going to present their cheapest option. Because when I ask, oh, why the 3-year fix? Why'd you get that one quoted? They don't know the answer to that. They're like, oh, that's what the bank told me. Because the bank doesn't care about your goals. They care about closing your business. And closing your business is showing you the most attractive interest rate without understanding your goals and if it fits for you. So again, just be cautious of this as you go through those conversations. When I think about the long-term fix and the short-term fix, as I mentioned, fixed rates primarily are chosen because of that predictability component. So when you're choosing a 3-year fix, the question is, what goal does that meet for you? Because it is a short term. 3 years comes up very quickly, as we know. In 2.5 years, because you would start to think about your mortgage maturity 4 to 6 months before it actually comes up for renewal. So you're really starting to put that back on the brain in about 2.5 years if you've chosen a 3-year fixed. I think the question has to be, does that meet your goal of predictability and stability then? Because I can tell you from where we stand today, in 2.5 to 3 years, I have no idea what it brings us. I just think that we can assume that we are in the same political climate, given how long political terms last. So we'd be in the same political climate. And if history repeats itself, that transition is not going to be a smooth time, economically speaking. I don't know if it brings lower interest rates. That could mean lower interest rates in 3 years. The bigger question is, do you want to be deciding that in 3 years, or do you want the stability and peace of mind of choosing a longer term fix? Yeah, a slightly higher interest rate, but a lot more peace because you're not having to think about these decisions for 5 years. What I tell my clients who lean towards a fixed term is that your worst of it is that component of FOMO, fear of missing out. Because there's a chance, a solid chance that interest rates go lower than what you've locked into on that fixed term. But that's the worst of it. It doesn't hurt you. It doesn't actually impact you. It's just a little bit of, oh, shoot, that sucks. The interest rates went lower than what I've got. That's the worst of it. 5 years comes up very quickly that you're renewing and making this decision all over again. Do I choose a 3-year, 5-year variable? You get to make that decision all over again. It's what meets your goals today. 5-year variable, that is giving you the most flexibility. How it's giving you flexibility is that the variable rate, just so I can break it down for everyone, is made up of two components: prime rate minus a discount. That discount is your fixed component. The prime rate is the variable component. The prime rate today is 4.45%. Our next Bank of Canada announcement is actually tomorrow, which we expect to hold. Nothing to change, rates to stay the same as expected. But the Bank of Canada meets every 6 weeks on a Wednesday. That is predetermined. They make an announcement every 6 weeks, but that doesn't mean there has to be any movement. But that is what your variable rate is dictated based off of. So if prime rate changes, so does your variable. So the flexibility is that if we anticipate that interest rates could go down in the near future this year, you would take advantage of that because your interest rate would go down. The other flexibility side of it is that you can lock into a fixed term at any time with no penalty. So that's a huge flexibility component and alleviates a lot of the risk with the variable to be able to lock into a fixed term if interest rates were to go into the opposite direction and start to trend upwards. Another key flexibility component is the fact that the variable will almost always be a lower, cheaper prepayment penalty. So if you were to pay off your mortgage, the variable is the cheaper penalty than a fixed rate. So in case you don't know what your goals are over the next few years, you want to keep it as open as possible. A variable might be a better fit for you.
And so when we talk about not knowing what our goals are, there's a couple of things that, could go outside, so just the realm of possibility here that I just want to highlight. Are you likely to be subject to an international relocation where you'll no longer be owning real estate in Canada and you need to pay out your mortgage? Are you going to be the beneficiary of a big estate where grandparents or, parents are passing away and you're going to be in a cash position where you're going to be able to pay off the principal on your mortgage? Are you going to be in a situation where you might be downsizing in the next 5 years and you're no longer going to be in your house? And the house, even though you still have money left on the mortgage, you're going to be selling it and moving into something smaller, which will eliminate the potential for the requirement for a mortgage. So there's a lot of things that can happen here. And so it's the biggest question that I guess. Can you just also touch a little bit, Jordan, on the correlation between the Bank of Canada announcements and why it doesn't have an immediate impact? Because I get this question all the time. The Bank of Canada will make an announcement that they've dropped another quarter point, and I'll get calls from people being like, "Great, does that mean that my interest rate has dropped another quarter of a point?" Not necessarily.
Not necessarily, because the Bank of Canada interest rate announcements are only exclusively directly related to your variable term mortgages. So you're only impacted if you have a variable term mortgage or a secured line of credit, because a secured line of credit is also based off of prime rate. But that is the impact that it makes to one's interest rate or payment or qualification. So only in the chances that you are in a variable does it actually have an immediate impact. For those of you who are on this call and already have a mortgage and are in a variable and you're here because you're coming up for renewal, how it impacts us is, because I'm in a variable term mortgage myself, is when the interest rate moves, fluctuates up or down, I do notice that it takes 1 to 2 payments usually to cycle through to actually have that interest rate applied in effect, like the updated interest rate. It can sometimes be a little bit delayed. So that's the impact, whether you're new or you have an existing mortgage with the variable.
Amazing.
Perfect. And now, the big question. And I'm sure you have an opinion on this, but the question is now a good time to buy? And I think we hear this probably every day, every week. And
Is
my
it a good
answer
time to buy? Is it a good time to buy and sell? Is it a good time to just sell? Is it a good time to refinance? All of the questions, Jordan, all of the questions. This is what 43 people who attended live here tonight and the 100 or so that will watch this tomorrow are all here to know. Is this a good time to do what I want to do, Jordan?
And my answer has remained the same through every market, I'll be honest, is that it makes sense to buy when the numbers make sense for you and the right property comes up. I think that that key point there, though, is that right property comes up. I think that's where there's a little bit more opportunity in this market than maybe other markets we've seen in the last few years. Now, I don't want to overspeak on any of the real estate agents that are on this call. I don't want to overstep on any of your professions. These are just some general market things I have seen. I know that they are so super dependent on the neighborhood, the type of property, the market that you're shopping in. But just generally speaking, for the buyers that I've been working with, we have noticed that there's sometimes can be a little less competition, which means if you look back 5 years ago, we knew that there were multiple offers, and by multiple, we meant dozens on dozens, like extreme competition. Opportunity to include conditions in your offer, something that each of your real estate agents would go through directly with you, which big ones, home inspection, financing condition, status condition, which are all just basic standard conditions that are, I don't know if I want to say, Carol,
Sale
but
of purchaser's property, Jordan, which is something we haven't seen a lot.
yeah.
We now have, so if you've got real estate to sell and you're apprehensive about what it's going to sell for or how long it's going to take, we're now seeing the ability to include that as a condition in your offer. Not in all cases, but in some, depending on the motivation of the seller or the property that you're buying, but has not been a commonplace condition in our marketplace for decades now and has made a return.
Yeah, that one is a major one. Like that
Big
tells you
one, big
about
one.
the
Yep.
market, exactly where it's at. And of course, a few more points here is potentially more room for negotiation if there's less competition, taking advantage of lower price points. And just to speak, so price points is one thing. The other thing that makes up the numbers, of course, is on my side, which is the interest rates. And I just want everyone to remember those trying to time the market or have this idea and concept of timing the market from a financing perspective of things. I think it's important to remember that we're coming off of 6% interest rates 2 years ago. I think it's really important to remember where we were before the pandemic. For a lot of our first-time home buyers or for clients doing their first renewal, they don't know where interest rates were before the pandemic. They think 1 to 2% is their norm. That's their norm. That's what they purchased in. Now for them to see, what's happening in today's interest rate environment closer to the 3 to 4%, that seems high because relatively speaking, it's very important to note that that's where interest rates were before the pandemic.
And
This
Jordan,
isn't.
I think we have to highlight this for those of you that are on this call that are waiting for mortgage rates to drop to 1.99% again. I want to be clear that was a circumstance that will not be repeated again in our lifetimes. I rarely make confident statements. I will make that confident statements. We will not see 1.99% interest rates again in our lifetime. The economic crisis that it created around inflation, not only in housing prices, but in the Canadian economy, and to be clear, not just in Canada, the low interest rate environment that existed all around the world, which was a direct result to a 100-year pandemic. We are not going to see that again. So if you're sitting there being like, yep, I'm going to buy as soon as I get a 1.99, it will not, like, don't hold your breath on that one, guys. It will, you'll literally suffocate yourself. It will not happen again. And so I think that's really important. The other conversation I have about, waiting to time the market is one, I have clients who say, well, I'm going to wait for the interest rate to come down another quarter of a point because it'll save me, $300 a month on my mortgage. But in the meantime, are paying $3,500 a month in rent, which is effectively 100% interest. So Just be really mindful, guys, that you have to look at this sort of holistically and from a higher level than getting lost in the decimal points of the interest rates or whether the market is going to come down, 2 or 3 more percent. The right time for you to get into home ownership is when it makes sense for you to do it financially, not with regards to everything else that's happening.
Exactly. And that's the main sentiment. Exactly what I started with is when it makes sense for you. I think the added bonus is what's happening in the market. And that's just an extra advantage during this time to be a buyer. I think also like I make the joke to clients who say they're waiting on that interest rate and things like that. I said, then you're waiting for another global pandemic. That's the joke that I make with them is the only time those interest rates have ever happened was when we also had the world shut down. So, I mean, you have to understand the severity that it took to get to those interest rates. And exactly to your point, Carol, the mistakes that were learned because we're still not out of that economic pandemic. Like we're out of the,
We could have another pandemic, Jordan, and they wouldn't drop the interest rates like that again. That's the reality. We could have
yeah,
another major global meltdown and they would not drop the interest rates like that again just because of the fallout.
we have not reversed the impact of what had happened during the pandemic still. So exactly to your point, it was, yeah, it I'll leave it at that, but it maybe wasn't the best decisions. But now here we are. So the room for long-term equity growth. I mentioned this, of course, because that's just the lower price points. So just gives you more room to grow from an equity perspective. Marry the property, date the interest rate is just a sentiment that we share because the interest rate, as we've talked about before, it's based on a short term. That's going to change every few years. So getting married to the interest rate is really not important because that's going to change over. You're dating it for a short period of time. Marrying the property means that the property was right for you, the payments were right for you, and it made sense for you and your family to grow in. Okay, so those are reasons why I think it would be a good time to buy today. Now, sorry to surprise anyone on this call. I have these payment scenarios here because we had done them recently for a couple of your listings. And I use this, I won't go through too much because I know that we're running out of time here. I just leave it here to show everyone what payments could look like on these real life listing
So these are
scenarios.
listings that are available to be bought today with 20% down payments. And I want to be clear, when you hear people talk in the marketplace, and I'll put my real estate hat on for a minute here, when you people talk about the fact that we are now in a situation where mortgages are carrying for less than rent, these are two live examples where both of these properties would rent if you were to rent these properties versus buy them, you would be paying more in rent than you would be to service the debt to own them yourself. So when you are paying rent, you are paying a mortgage. It's just not your own. And we can see now for the first time with the increase in affordability in terms of purchase prices and the decrease in interest rates that now we have scenarios where it is actually cheaper to buy than it is to rent, which is crazy.
I think it's I was just going to say it's been like a couple years of a hard market, but I have to say these are some of the most exciting conversations for me because just saying circling back to what I mentioned about the empowerment of what you don't know. When I go through those client calls of the clients who started and they've counted themselves out, they're like, no, 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 I'm just having an intro call. Like, I don't know. Like, Carol sent me to you to just have this conversation. And then we do the assessment and I can see the flip when we're going through the affordability that they didn't know they could qualify for. And then you show them a listing that's actually within their price range. And then I go through the payment sample. These are like truly like, I know it sounds so cliche and silly, but those are the calls that make me so excited because I can see the actual flip from the feeling they started with to actualizing their goal. It's
So
just
real life scenarios, Jordan. I love it. Thank you for sharing. The slide deck will be available. You guys can scrutinize this. I want to move on to renewals because I know
yeah,
there are people that are dying
waiting.
to hear it. And there's a lot of people out there that are facing renewals. We know that oh, here we go. The slide is for renewals. So huge amounts of people that are coming up for renewal. And I got to say, Jordan, the aggressiveness of the call. So I have a mortgage that's coming up in August to the day at the 6 month renewal point. I started getting calls from my bank about and high pressure sales tactics from the bank, almost predatory, frankly, if I'm being honest. I'm somebody that has a high level of knowledge, and the language in the emails and the voicemails that I'm getting from the mortgage agent at the bank, unbelievable. And if I was perhaps less versed in the reality of the situation, I might feel compelled, like I have to act quickly. and just a lot of misinformation being shared on those fronts. So I want to be clear, if your mortgage is coming up for renewal in the next 6 months and you're in that renewal period, you are going to start getting hammered with phone calls from your lender to get you back into a renewed mortgage product. You do not need to make a quick decision. You should be getting a second opinion. Always, always, always. I get second opinions and I'm fairly well versed in this. I go to Jordan and I say, Jordan, my
Mhm.
Scotiabank mortgage is coming up in August. Here's what they're offering me. What do you think? So it is really important, guys, that A, you take a breath and know that, they will put things in front of you that say, well, this offer is only good for the next 24 hours because they know you can't get a second opinion that quickly in most cases. They will say, well, my manager only gave me, you have to accept it today. Otherwise, we won't be able to guarantee this rate. They will say, well, the next Bank of Canada announcement is coming up and your interest rates might go up again. High pressure tactics, guys. They want you to lock in as quickly as possible. Take a breath, know that you have options, explore those options before you sign anything. This matters a lot.
I cannot stress how much that matters. And I can tell you that two of my calls today alone, like I can tell you of multiple in this week, but just today alone, I can tell you of two frustrating renewal calls that happen. One of them is the scenario that I kind of mentioned about the client. I reached out to her, her renewal is coming up in about 2 months. So I said, hey, like, did you get your renewal rates, whatever? She's like, oh, I actually already talked to the bank. I'm going to sign in with them, whatever. And I was like, let's chat before that. It was a classic approach of, oh yeah, they quoted me a 3-year fix. I said, oh, why a 3-year? Like, what are you thinking about doing in the near future? Then she says that, oh, I might sell in the next few months, which is something that I guess the bank advisor forgot to ask. The point is if she's
Mhm.
going to be selling in the near future, they have set her up for failure. They have set
Well,
her
huge penalty. Set her up for a
for
huge penalty.
penalty. That's what I mean. So for financial failure is what I meant. Because I said we talked through it all and we talked through her goals and I said flexibility is what you need. You haven't listed yet, you haven't sold yet, you don't know when you're going to sell, but you need to and you're going to purchase. You need flexibility. You don't need the lowest rate today. We need to focus on that when you've purchased your home that you're going to purchase. The renewal period, we need flexibility because we don't know when you're going to pay off your mortgage in the next few months. These are conversations they didn't even have with her, let alone they were trying to sell her the 3-year fix. They didn't even tell her what the 5-year options were. Don't know why. They should be giving you all the options. Like, at least if they're going to make this phone call to you, they can give you all your options up front. But they know that not all clients know what to ask for on these calls. They think, oh, this is the 3-year. I guess this is what I get. And I guess I just sign up for it. They didn't know to ask her what her goals were. They told her that she has to make a decision by tomorrow or this rate will expire. Every bully, and I told her straight up, these are bully sales tactics. They do not care about how it fits with your goals. They care that they retain your business and close your business. That's their only goal. That's it. And the thing is when we have these renewal check-ins, I get your renewal rates up front. I want you to tell me what your renewal rates are because I'm not going to make you go through an application if I don't think I have a better fit for you. I want to make sure, I want to review the renewal offer you're getting and make sure it fits your needs depending on what those goals are. So it's not a tactic on my side to even get your business. There's a good chance that you end up closing with whatever bank you're still with, and that's okay. But you need to understand that your mortgage renewal is an opportunity to revisit your goals, whatever they may be. We're going to go through what those might be, but it is, like Carol said, so important that you have this conversation. You need to get that second opinion. The bank is not there to protect you. They are not there to look out for your best interests. They are simply there to close your business. And I'll also say in the back end, in terms of mortgages, we can tell you that banks, they being banks, invested a lot of money into the retention teams to make those aggressive phone calls. That's why you're getting them like every single day in your renewal period, because they invested a lot of money knowing this fact on the screen that there's about 60% of all outstanding Canadian mortgages are going to renew between last year and this year. That is a huge number. That is hundreds of billions. We're not talking hundreds of millions. We're talking hundreds of billions with a B. So the bank has put in these measures to aggressively call you, bully you into making rush decisions because they don't want the chance of losing your business and finding other better suited fits. So I just can't stress enough. have that conversation. It doesn't mean you necessarily have to go elsewhere. It just means that we're able to identify if there's other goals. And
And I want to be clear, Jordan. Like I have a rental property where the mortgage recently renewed. Actually, there's two rental properties. They were both renewing at the same time. It was a CIBC mortgage. And listen, I got a lot of love for CIBC. I bank with them for a lot of our business banking. Had a call with them. I'm like, is this the best rate that you can offer me? Yes, absolutely. We appreciate your business, Carol. We know that, you have a lot of business with us. This is the best rate that you can give me. Absolutely. Reached out to Jordan. Jordan's like, yeah, Desjardins is actually offering, 0.14% cheaper than that on rental properties right now. I didn't even go through the approval process. I shared that information with CIBC and they were like, yeah, okay, we can actually match that. I'm like, what happened to the best rate? So the importance, guys, of a second opinion, the it doesn't sound like that's a lot, but multiplied over the life of the mortgage, that is thousands and thousands and thousands of dollars. So please take a minute and we've belabored this. I feel like we're just preaching now, Jordan, but I love this. So when should you start thinking about your mortgage renewal? The bank is thinking about it now. If you're
yeah.
renewing in the next 6 months, they're ready. They've got you on speed dial on day one.
Well, that's what I was going to say is if you're the bank, they're starting to think it at 6 months. And here's why. I need you guys to understand why the 6 month early renewal period. It is all by design. 6 months is because you can only start to lock your interest rates in if you wanted to start going shopping elsewhere, find better interest rates 4 months prior to your maturity. So that 2 month gap is when they're trying to aggressively call you and make you lock in before you can start to shop around. That's why they're making those aggressive calls. So it's so important, unless there is a major reason for you to early renew and we check out all the numbers and it makes sense to do so, you need to know that it makes sense to hold off because they're just preventing you from doing your own due diligence and shopping. That's all they're doing.
Yeah, this is not a situation where you get like a bright star for renewing early and it's a thing off of your list, like paying your property taxes the day that you get them. This is not the same thing, guys. There's an actual strategic decision for why they're
Absolutely.
encouraging you to renew early.
Yep. So you'll start to get those calls from your existing bank about 6 months prior, but we will start our conversation. We can start that as early as 4 months prior, just because that's the timeline that we can lock in interest rates for. So another thing I actually want to clarify, because this is an email I actually just got this evening, is I was reaching out to my clients that are coming up for renewal this year. And one of them responded, she's coming up in May for renewal. And she responded to me saying, hey, thanks for reaching out. But I actually, because 5 years ago, they're in like 1% interest rate. She's like, I don't want to early renew. I'll talk to you a few months later when it's relevant. I will respond to her later, but I want to bring this up as an example of there's a misconception that locking in an interest rate means we're going to make it effective the day of. We're not doing that. You're going to stay in your interest rate and your mortgage until the day of your maturity. We're just advanced shopping it because we want to have as much time to do that shopping, get it in place, check rates out, check out different programs and policies, and place it where it needs to be. It's not about, we're not trying to close your mortgage quickly. Like, we're not doing that whole sales tactic. We're shopping it quickly. So I just want to clarify that, yeah, a lot of your mortgages, I'm sure if you got it 5 years ago, are in those extremely low interest rates. That doesn't mean it's too early to start the conversation. We need to get all of that prepared in advance of your renewal date. So just something to know. And I guess that's my last point, is making sure we have the conversation as early as possible. Make sure, what I do for clients is, I'm sure if anyone's on this call or clients wise, I'll send calendar invites. So even if you do reach out to me too early, that's okay. It's never too early to start the conversation. Reach out to me a year in advance. Once I get that call, we talk through it. I'm going to send you a calendar invite for 120 days prior to your maturity date. On that date, I always ask my clients, reach out to your bank, get your renewal rates. Once you have them, let's schedule a call. That call is we'll chat through their renewal offers, your goals, and then next best steps. So I do a full review of everything, even not my own offers, just to make sure that you're getting the best situation for yourself. Now, renewal versus refinance. This is a big question. Most people, I would say, don't actually know the difference between a renewal and a refinance. So starting with the renewal, that is your more straightforward process, I'll say. Renewal means that you're staying with the same bank, your same lender. You cannot take out new funds in a renewal, staying at the same balance that you renew at, no adding a line of credit, no changing your amortization. You're just simply choosing a new rate and a new term at that time. That's all you're changing in a renewal. A refinance means that you might be changing something a little bit more than just the term and the rate. So we might be switching banks for whatever reason or lenders for whatever reason. We might be taking out equity from your home. We might be adding a line of credit, which is technically adding equity. We might change the amortization or the structure. Anything where we're making big changes to the mortgage itself would be deemed a refinance. A renewal is when a renewal doesn't need any application process, generally speaking. Now, I have seen in very odd cases that the bank does reserve the right to requalify at renewal, but majority of the cases they don't. They're just, as long as your mortgage is in good standing, you've made payments on time, they're just going to give you a new rate sheet and terms and have you select. A refinance, on the other hand, to be able to switch lenders, access equity, or do anything else, does take an application. So we are doing an application to refinance because we have to requalify for whatever new mortgage structure we are doing. Now, refinancing, again, why this is a big thing with renewal is it's a huge opportunity to look at future goals, current goals, and at least plan for them. I have a client, for example, who's going to retire in the next 2 years, and she knew she was going to retire. So before she did that, she refinanced to add the largest line of credit against her property because she knew in about a year's time, she won't qualify for any debt. She's going to have no income. She's going to retire. So she said, let me just get this set up and ready because I know down the road I'm not going to be able to qualify for this. But I know in my future goals, this is something I might want to have to do renovations, investments, but I won't qualify for it. So this is what I mean. It's not just your current immediate goals. We're trying to plan for your future. What do you have retirement? Do you have inheritance? Do you have moving plans? All of these things come up in this conversation. So we can try to tailor your mortgage and your financing accordingly.
I can't underscore this enough, Jordan. Like accessing a line of credit before you, and when I say accessing, I mean arranging a line of credit. Doesn't mean you're borrowing on it, but accessing a line of credit before you retire is absolutely key. I have been in real estate for a long time. There are so many circumstances where people need access to money. There will be, obvious ones like I want to be able to lend my kids some money for a down payment and they're going to make the payments on it, but I want to be able to access some of the equity in it. I have seen heartbreaking ones, Jordan, where they need to travel abroad for advanced medical care and they can't access, they have to make the decision between selling their house to be able to access the funds, which they would be able to leverage on a line of credit, at least temporarily and quickly, to be able to get them into the, treatments in the other places of the world that they choose to go. So many assistance for a parent that needs to go into long-term care and they need to make big payment for that up front until the parent can, sort out their living arrangements. There are a lot of reasons where you may find yourself in a situation where you need to access the equity in your home, maybe not permanently, but quickly and efficiently. And so even if you're never going to touch it, I would encourage you to have a line of credit before you retire arranged on your house because once you have no income coming in a conventional sense, your ability to access it is severely diminished.
Absolutely. And if you guys notice the pro tip, again, I think the deck is going to be sent out, or if you need to screenshot, that is Carol pretty much highlighted all the reasons you would use a secured line of credit. I tell everyone who qualifies for it, you should take it. I'm never here to pressure if you don't feel like it's your fit. As long as you are responsible with credit, like as in you're not going to advance it and frivolously, let's say, because it is a big limit usually. It is a big loan amount that they give you access to since it's secured against the home. But huge reasons clients use it are renovations, consolidating higher interest debts, investments, like investment opportunities, exactly like you said, family support, improving monthly cash flow. Some clients are in circumstances where they need to access that for day-to-day expenses. It just gives you access and flexibility. And if you never
Emergency
use
medical.
it,
I can't tell you how often, Jordan, I've got clients that are, they get a terrible diagnosis and they choose to seek medical intervention elsewhere in the world because that is the latest technology and that's where they want to go. It's not covered by, private or public health care and they want to use the access in their. So, anyways, I digress. Good reason to have it, guys. I'd rather that you have it and not use it than need it and not have it. And again, you don't pay interest on it. There is no cost associated with having it. It's just there as an option if you do need to draw down equity quickly.
Yeah, exactly. No cost to having it. It's like a credit card in that way, just a really big credit card. In that interest is only charged when you have a balance and full prepayment flexibility. Because, like you said, maybe it's just quick access. You didn't have enough time to liquidate assets. You can pay it back down to zero in your time. Uh, full prepayment privilege and flexibility. And in case it's a cash flow goal, just so you know, the line of credit is interest only payments. So it is helpful for a cash flow because you only have to make interest only payments on it. Now, I'm going to run through these last little bits here, which are the things to
Super quick.
consider.
We got to get to the
Yeah.
questions, so let's go
Yeah,
quick.
I know. The things to consider, I mean, we pretty much went through all these. This is what you want to think about when you come up for renewal, what we're going to talk about when you have that opportunity. So, of course, the obvious interest rate and term, that's just figuring out what rate and term fits you best between short and long term, fixed versus variable. We will chat through that. Monthly cash flow, huge thing right now in this kind of economy, cash flow. How that comes up in a refinance opportunity is extending amortization, which is generally something you cannot do in a renewal. Extending your amortization allows you to make lower monthly payments, which is helpful for a lot of people today. Accessing home equity, as we talked about, that can be a line of credit. It could be a mortgage. You don't have to take it out as a line of credit, by the way. If you know you're going to use it right away, you can take out mortgage funds. As we talked about, major life expenses, renovations, investment opportunities, a whole bunch of different ways that you can utilize that equity. So that might be something we consider. Equity there, consolidate high interest debt. So that would be, this is also something we're seeing big time. People don't even know that we can do it. A big one I love to do that people don't realize is if there's enough equity in your home, it often can make sense for us to refinance and consolidate your high interest debt. People don't think about this, I guess, because sometimes they don't even know you can do it. If you have running credit card balances, 10 grand, 20 grand, 50, 100 unsecured debts, those unsecured debts are charging you anywhere between 10 to 20 upwards of interest rate, 10 to 20% plus on the interest rate of unsecured debts. So consolidating those debts into a lower interest rate by like we're cutting that interest rate into like a quarter or half even. That is going to be helpful, of course, from interest and cash flow. But the one that gets me excited is when there's enough equity to also consolidate not just your unsecured debts, but car loans. Why car loans is an exciting one is because, yeah, the interest rate isn't usually that bad on a car loan, maybe 5, 6, 7%, nothing that crazy, but it is usually clients' second biggest monthly installment. So when we can roll that all into one and make it just one clean payment on your mortgage, consolidate your debts, it's a thing that a lot of clients are liking right now, especially again, just because cash flow is very sensitive in this kind of economy. I think these are just the last few points here of the refinance options.
Then we're going to get in some questions, Jordan. So if you guys, I have some questions that were pre-submitted, but if you want to drop some questions into the chat for the attendees that are with us, I'll go through them and we'll try to pick ones that are relevant to the broadest group possible, and then we'll do some specific questions in a personal way after the fact. But if you want to drop your questions into the chat.
I just want to end on this sentiment then. Obviously, all the other things we've talked about pretty much in depth, but this sentiment is so important, not just for the renewal side. I think this is important for first-time home buyers, refinance, renewal. The best mortgage for you depends on all of the goals that we talked about, not just the rate. I find that interest rate oftentimes is what clients come to me and it's their first question. I think in this type of economic environment, the interest rate is almost one of the least important factors because as we talked about, when we're talking about the terms that you're choosing between fixed and variable, this economic climate, I think it's much more about your goals, your personality, and your risk tolerance than the interest rate itself. So it's really important that you don't just take that first 3-year rate that you're getting offered.
Thank you, Jordan. I'm going to go through some of the questions that we asked ahead of time, just as we kind of wrap it up, and a lot of them around mindset. And so I want to read this one. It was submitted by Nicole. We are a young family of four, two young children currently living in the city, and we're eager to purchase a home for ourselves. We've been renting for 10 plus years. The process seems very discouraging, and we also saw it as something that we could never afford. We also don't have many homeowners in our family, and we want to be the ones to stop the cycle to have something to pass down to our children. Where do we even begin? Is it even possible with our combined 150K salaries to stay in the areas we love? I want to just touch on this for a minute because I've heard some version of this over and over and over, as I'm sure you have, Jordan. So a couple of things. So yeah, renting for the last 10 years. So to be clear, paying a mortgage, unfortunately, just not their own. They're paying to service the debt for somebody else to build equity. So I totally understand, Nicole, your desire to be able to get out of it, break that cycle. The lack of homeowners in your family is something that we also see very familiar, that is very, very common. I came from a family where home ownership was not particularly common as well. Jordan, you've shared that sentiment before as well, for you personally. And both Jordan and I have had the privilege to be able to work with so many people who were they were the first people in their families to become homeowners. And when you don't have that mentorship or that first hand example in your home of what it is to go through the refinancing or financing process, like nobody is born with a guidebook to understand how to do this. So Nicole, I'm going to really suggest that you sit down and you chat with Jordan, and with your real estate agent about what that process looks like for you. The only thing that I'll say is really this is a mindset, and when we say it feels discouraging, I have never in my life, in my real estate career of 20 years plus, and this goes back to what we were saying about like Instagram, Jordan, the amount of misinformation that is shared that is intended to discourage people from entering home ownership is overwhelming to me. And I'll give you an example of what it looks like. Home ownership is a fallacy. You shouldn't be buying your own home. You should stay a renter, and you should be investing in crypto instead. And you should be buying, blank investments instead. Guys, I want to be clear, that is influencers who get compensated by driving you towards the investment strategies that they are selling, even if it doesn't look like an ad. These are influencer accounts. They're created to drive you towards very specific investment strategies that diverge from home ownership. And to be clear, guys, homeownership is not a discretionary expense. When you go to bed at night, it's 8:30. Some of you will be, tucking into bed in a few hours. You're going to need a roof over your head. So we don't have discretion over whether or not we pay for housing. We do have discretion for how much we pay, where we live, and whether we choose to own or rent. The security that comes not just from the logistical part of housing, like you having the decision about when you're going to move houses, or because when you're renting, you don't have that discretion. It should stay within your wheelhouse, and it is still the best vehicle to build long-term wealth, not just for you, but yes, also so that you have something to pass on, for your children. So Jordan, I mean, I think we've talked about the process a lot. Can you just talk about the mindset of like home ownership isn't for me? It's out of my reach. What does that look like for you, Jordan, when you talk to people like that?
Yeah, no, I mean, I literally want to put my hand on my chest when I heard you reading that message.
Yes.
I hear it all the time. And I just wish that I could literally call you personally right now to have that conversation, because it is something that I think once you start to, just like anything else, any anxiety, once you start to talk it out loud, it becomes way less scary, way less intimidating. And especially if you're talking to the right person or advisor about it, instead of, like doing the Google, the Chat GPT, or the TikTok, whatever. We all do it. We all do our online research. But once you take that next step to have the conversation, I really feel it just naturally dissolves so much of that doubt that you have. And I can speak from experience, and I'm sure you can too, Carol, is we've seen first-time home buyers of all kinds, by that I mean of all ages, of all starting price points, of all down payments price starting points. Like, there is no one person or one income type and down payment type that qualifies for a home, right? We've seen it all. And your starting can be when you're 20, it can be when you're 40. It does not matter. And there is no shame in that. It is so exciting that you have that in your mind, because that means that you want it. And I think that means that you could be ready for that conversation. Because it's already on your mind.
Average age of a first-time buyer now in Canada. 41 years old, guys. Just be mindful of that, 41, which is sad, but because it means that people have been likely and household for
Oh,
independently is 26. So now we have a 15-year gap where people are, paying rent towards somebody else's mortgage and not taking advantage of the equity. But if you are in your 40s and you're like, wow, there must be something wrong with me. I haven't been able to bridge the gap into home ownership. I want to be clear, guys, the average age is now 40 plus. So, and again, I think we'll start to see that come down a little bit because the interest rates in the last few years have come down and the affordability is coming down, or sorry, increasing with the purchase prices coming down. But let's be mindful, guys. It's not a race. It's just what is the right time for you. I want to ask a question about independent contractor income that we have from Olivia. Given that I earn both T4 and independent contractor income, what should I be doing over the next 3 to 4 years to present my income in the strongest way for a mortgage approval, specifically around tax filing, income consistency, and documentation? So to be clear, we can't give accounting or tax advice here, but from a mortgage perspective, Jordan, what are some strategies for self-employed people that you would encourage people to keep in mind?
It can go one of two ways. I think the advice would like not advice, but what I will say when you're self-employed, whether incorporated or a sole proprietor, is the big banks, they are just looking at your taxes. So I'm not advising you necessarily to keep everything as gross and net income, don't expense, but that is essentially the bank is looking at your net income over 2 years when you're self-employed. I can speak for as a self-employed person that I expense as much as I can. So I show as little income as possible to stay tax efficient, right? Because I think it's really important to note that your goal to be tax efficient is not the same goal as qualifying for a mortgage. And I've done seminars actually with accountants, partnering with accountants, because we will always show you that it is still cheaper to file taxes efficiently and be open to alternative solutions for financing. Always cheaper that way, because otherwise you would need to claim your taxes and be taxed at probably a 30 to 40% tax rate 2 years over, show a pretty high net income, so expense minimally, and you're paying taxes on that. Versus, this is where I want to mention when you are self-employed, we do have what's called stated income programs. Very specific. We have to talk about it case by case for who qualifies for these, but essentially not the big banks, but or not usually all the big banks, some big banks, a lot of smaller lenders will look at your 12 months bank statements and look at your income deposits to figure out what your income is more accurately than what you claim on your taxes. Now, it's important to note, though, that lenders and specialty programs like that can sometimes come with a lender fee and a little bit of a higher interest rate than your standard big banks. But that's why I mentioned that, yes, it might be more expensive on the financing, but it is still cheaper than filing your taxes to qualify, to jig your taxes to qualify, essentially.
So I think that raises a really interesting point, Jordan. So just for clarity, if I'm hearing you correctly, because we've got a bunch of realtors that are participating who are self-employed effectively, your best bet in those cases, in most cases, may be to maximize your legal write-offs to minimize your tax implication, but be open to the idea of alternative lending, which comes at a slightly higher interest rate, but that would be offset by the fact that you're saving a lot in taxes as opposed to just not claiming things that you're legally entitled to claim to get the benefit of the bigger stated income. But I want to just talk about the big bad boogeyman of B lending, Jordan, or the perception of it. As soon as people hear, that it's not one of the big five banks financing their mortgage, they get freaked out. Can you just talk quickly about the benefits of sometimes going with not even a B lender, but I'll say not one of the big five,
Yeah.
and what that looks like?
Yeah, for sure. So we work with over 80 lenders, and that's important to know because we do have three of the big
That's
five.
75 more than a lot of people even realize lend money. So
It's true. It's true. And each category kind of has its use of where we might use them. So, for example, credit unions can help for more outside of the box situation, extended ratios, things like that. Sorry, to explain that, extended affordability, things, exceptions to that. Monoline lenders is a term you'll hear when you work with the mortgage broker. Monoline lender just means all they do are mortgages. They don't have a banking component to them. They tend to be competitive when you're doing an insured mortgage, less than 20% down. They stay competitive in that space to the big banks. And then you have your B lending and your private lending. B lending, I really just want to say about that one, it's everyone thinks there's a negative connotation to it, like, oh, like it's a bad thing. B lending is alternative lending. And I will tell you that I, as someone who is incorporated, self-employed, I am the fit for B lending because it is again made for, yes, there's some credit scenarios, like income scenarios that they look at, but primarily where we use it is self-employed clients. They are so much more lenient and customizable and logistic, I would say, when it comes to viewing self-employed income, whereas banks, very black and white. Taxes, I don't care what your bank statements show, I don't care what you say you make, I'm looking at what you claim on your taxes and that's it. So it really is a big, big benefit to work with these B lenders when you're a self-employed. Nothing to do with bad credit, nothing like you've done wrong, anything wrong. And it's a small cost, being usually 1% of the loan amount. So if you're taking a $500,000 mortgage, 1% is $5,000 added to your closing costs. And the interest rates tend to be about 1% higher than the big banks. So that's your difference when you're talking about a B
But
lender.
it's a difference between sometimes getting qualified and not getting qualified, or saying, oh, I guess I'm going to have to wait another 5 years, or home ownership is not for me because I'm self-employed and the lender, told me that they can't finance me. I would rather you pay 1% interest more than 100% interest to your landlord in rent every year going forward.
And when I show people the actual like case by case, like the cost, because I want to show people the fee and the payments, they're like they're shocked by how not bad it is. They're always like, oh, I had imagined way worse. Like they almost always will say that. And it's important to note with B lenders, they primarily work in short term, so 1 to 3 years. And the reason being is one, for their own sake, like renewing funds, but a big benefit as the client is being able to revisit that again, as we talked about. Once we hit your renewal, we're revisiting your refinance opportunities. B lending is often used as a short-term solution to get into this market. You haven't done your taxes aren't done right, but you found the right property today. Great. There's a B lender solution for that. Let's get everything sorted over the next 2 to 3 years. 2 to 3 years when your mortgage comes up for renewal. Let's relook at where things are at. And maybe we can actually refinance into an A lender at that time. So it can really be a short-term solution. And I've seen it many times over work out that way.
Yep, amazing. Well, Jordan, thank you for tonight. People are going to have other questions. How can they reach you? I can see your contact information here. We're going to share the slide deck with everybody and the recording of this, and that'll go out likely tomorrow. And you can reach out to have a confidential conversation with Jordan, just so that you guys know, if you do reach out to Jordan, that information is private. It's not shared with us. So you can disclose all the things that you want to share with Jordan. You can call her, you can email her, you can text her, you can find her apparently on all the socials, because that's how your generation talk to people, Jordan. I love it. And then, of course, you're going to get a follow-up call from the agent that invited you to the call today, either whether you're registered and here live, or you registered and you're watching later. You're watching the recording in the following days. You will get a follow-up call as well. It's been a pleasure, Jordan, to chat with you tonight. Thank you to everyone who hung in with us tonight. I want to quickly just share our next upcoming masterclass, which is going to happen in March. Dave is going to share the graphic for this. If you want to stop screen share, this is a really important one, guys. So we've talked about mortgages, we've talked about home ownership. I want to talk to you in March about, oh, here we go, wills and estate planning. This is our most popular masterclass that we host every year. We get hundreds of people showing up, and this is because homeownership is part of the equation, but you want to be sure that you are protecting your legacy and you're protecting your assets. So we are going to have our next masterclass around wills and estates, planning ahead with insight and confidence. If you own real estate, if you don't own real estate, if you have savings, if you don't have savings, if you have children, if you don't have children, you need a will and you need a power of attorney. If you live in Canada, that is the reality of the situation. We're going to be hosting a masterclass. Registration details will follow. We're going to be giving away a free wills and estates package, courtesy of the lawyer that is hosting with us. So we're going to be excited to see you on that. But if there's anything that we didn't touch on, whether it's mortgage related, or if it has anything to do with real estate or mortgages, please reach out. It's always a pleasure to be of service to you guys. And it's been a pleasure to be in community with you guys tonight. We're here to help. I hope you guys have a wonderful rest of the week. It's Tuesday, January 27th. Hopefully you've dug your driveways out, and we will catch up with you guys again soon. So thanks for watching, everybody. Good
Thank
evening.
you.
Thanks, Jordan.